Welcome back to The Deep Dive, the show built to cut through the noise and deliver pure, concentrated knowledge extracted from the sources you need to be well-informed.
Today, we are not just skimming the headlines about the market. We're doing an exhaustive study of the stock market, that essential aggregation of buyers and sellers of stocks, which, represent ownership claims on businesses.
And our mission is crystal clear. We really need to understand the sheer, almost terrifying scale of this institution, how the plumbing of exchanges actually works. And most critically, we're drilling down into the deep stratification, the uncomfortable reality of who owns what, and how market psychology, not just rational thought, dictates its most massive swings.
And we absolutely have to start with the scope. I mean, if you don't grasp the scale, you just can't understand the system's centrality to global finance.
It sets the stage for everything else.
Exactly. We're tracking the total market capitalization of all publicly traded stocks worldwide, and the growth curve is, it's genuinely exponential.
Okay, let's unpack this. In the context of global history, where did this acceleration really, take off?
Well, historically, the market was significant, sure, but it was also kind of niche. In 1980, for instance, the global market cap sat at about US $2.5 trillion.
$2.5 trillion.
Right. Now you jump forward to the end of 2023, and that figure it's exploded to a massive US $111 trillion.
That is not just financial growth. That is a fundamental shift in the geometry of global capital. We're talking about a structure that, 4 decades ago was specialized, but now dictates housing prices, retirement security, and virtually every aspect of modern economic life.
It really is the central nervous system of global finance.
It is.
And remember, we're extracting all these key facts and insights from a comprehensive review of the market's definition, structure, history, and the often overlooked participation demographics. We want to give you the full picture.
So to truly wrap our minds around that $111 trillion figure, we have to look at its geography. Because despite being a global system, the activity and the wealth concentration are surprisingly centralized.
Oh, highly centralized. When you picture the stock market, you picture Wall Street, right?
Of course.
And that intuition is remarkably accurate in terms of actual economic weight.
How accurate? Precisely. Let's get into the data on global weight.
Okay, so as of January 2022, the United States market is the undisputed global leader. It accounts for about 59.9% of the world's total public equity capitalization.
59.9, so almost two-thirds.
Almost two-thirds of all formalized corporate ownership is concentrated in one country's financial centers.
That concentration is just staggering. It means that major regulatory or economic decisions made in Washington, D.C. or at the NYSE, they have an instantaneous, outsized impact on wealth creation everywhere else.
Exactly. The nearest competitors are, they're far behind. Japan is at 6.2%, and the United Kingdom is at 3.9%.
A huge gap.
A huge gap. And since centralization isn't just national, it's also institutional. In 2016, out of about 60 or so formal stock exchanges worldwide, only 16 of them held a market cap of $1 trillion or more.
Only 16.
And those 16 massive exchanges accounted for 87% of the entire global capitalization. So the market is immense, but the true centers of gravity are very, very few.
This helps explain why events on the major exchanges don't just ripple across the world, they generate immediate tsunamis. Speaking of those centers, let's define the plumbing. What is the fundamental regulatory function of a stock exchange at bourse, beyond being just a physical or virtual meeting point?
Well, it has 3 core functions that really make the whole system viable. First, it's a facilitator, a regulated marketplace where buyers and sellers read through their brokers and traders.
Okay.
Second, and this is crucially important for modern finance, it provides liquidity.
Liquidity, meaning you can get your money out fast.
Right. It means you can instantly convert your shares into cash without suffering a significant loss of value. Without exchanges guaranteeing that ease of movement, stocks would be far less attractive assets.
So it turns an ownership stake into a highly tradable, readily available asset. What about the final function?
The third function is acting as a guarantor of settlements.
A guarantor?
Yeah. When you buy a share, the exchange mechanisms ensure that the seller actually delivers the security and the buyer delivers the cash. They essentially eliminate the risk that your counterparty might default on the transaction.
Which is fundamental for confidence.
Absolutely. It's all about maintaining investor confidence.
That guarantees trust. If I buy 100 shares of a company, I know I'll receive them, and the seller knows they'll get the money. It's a regulated ecosystem.
Precisely. And the mechanism for facilitating those trades has gone through this radical transformation. contrasting the old physical floor with the speed of electronics.
Yeah, the history is rooted in that open outcry method, that frantic scene of traders shouting bid and offer prices at each other. You still see it sometimes in commodity trading.
Right, but that's largely a historical artifact in modern equity markets. The modern trend is speed. We have purely electronic exchanges, like NASDAQ, where all trading is done over a computer network.
And the trade is matched in milliseconds?
Instantaneously, yeah. When a buyer's bid price hits a seller's ask price, it's done.
But the New York Stock Exchange, the iconic symbol of capitalism, it still uses a hybrid model, right? It still has that famous physical trading floor.
That's right. It blends the electronic order matching with the physical floor. And this leads us to a really specific, unique function on the NYSE floor, the role of the designated market maker, or DMM.
The DMM, they're often described as this stabilizing force, but how do they operate in practice, and where's the incentive for them to maintain that stability?
Okay, so the DMM is an individual or a firm assigned to a specific set of stocks. Their primary regulatory job is to maintain a two-sided market.
Meaning
They are compelled to always be ready to make an order to buy and an order to sell. They have to ensure that trading can happen even if demand or supply temporarily dries up.
So they provide constant liquidity, but what happens when the market is unbalanced and the bid price, what buyers are willing to pay, is far below the ask price, what sellers are demanding?
That gap is called the bid-ask spread. And if that spread gets too wide, the DMM has to step in. They use their own capital.
Their own money.
Their own money or their own stock to effectively close that difference and facilitate the trade. It ensures the market stays orderly and doesn't suffer these extreme price swings just because of a lack of an immediate counterparty.
That sounds incredibly risky, but also necessary for the market to function smoothly. If they're providing the stability, they must be profiting from the role somehow.
That's the critical question. The DMM profits primarily from that bid-ask spread. Their job is to buy low and sell high, often collecting fractions of a penny on every single share traded.
And they're doing a high volume of trades.
A huge volume. Because they are the guaranteed counterparty. Their risk is mitigated by their specialized knowledge and the regulatory requirement that they maintain a substantial inventory ready to intervene.
Is there a risk of moral hazard there?
Well, that risk is always inherent whenever a central authority acts as a backstop. If traders know the DM is there to prevent a complete collapse, it could theoretically encourage slightly more reckless behavior. But the regulatory scrutiny on DMMs is extremely high to prevent them from exploiting their privileged position.
So the DMM is the human face of order, backed by technology. But we know not all stocks trade this way. We often hear about trading that happens over the counter.
Correct. Stocks can also be traded over the counter, or OTC. That just means they're bought and sold directly through a dealer network rather than on a formal centralized exchange like the NYSE. This market often deals with smaller, more speculative stocks.
And historically, there were other alternatives too, right? Like third markets?
Yeah, third markets like Internet were popular for a while to avoid exchange commissions, but they faced other issues, things like adverse selection and eventually a lot of regulatory scrutiny, especially with things like dark pools.
Right, dark pools. The concept of adverse selection is always mentioned there. What exactly is that in the world of stock trading?
Adverse selection is it's an information asymmetry problem. It happens when one party in a transaction has information about the security that the other party doesn't.
So in a dark pool, a big institution might be selling off a massive block of stock without the sale immediately hitting the public price.
Exactly. And that's the problem. If you're trading in a dark pool, you might be buying stock from someone who knows something fundamentally negative is coming down the pipe, and they're using that dark pool specifically to liquidate without sending a massive panic signal to the public market.
So you're on the adverse side of the trade because of that information gap.
Precisely. Now, the reason institutions use them, conversely, is to avoid showing their hand. If they tried to buy 1 million shares on the public exchange, the price would jump before they even finished their order. So dark pools, despite all the regulatory issues, they do provide a place to execute large trades without suffering that immediate price impact.
It sounds like a constant regulatory balancing act, enabling efficient large-scale trading while trying to prevent informational exploitation. That complexity just underscores how intricate the plumbing of this $111 trillion market truly is.
And having established the infrastructure, let's pivot to the human element. Who participates in this massive system and what factors draw them in or, well, keep them out.
The primary motivation seems straightforward, right? The appeal of potentially higher returns compared to bonds or savings accounts or real estate. But our sources show that purely rational calculation only explains part of the story.
That's right. Participation is influenced by these really complex factors. The actual high price of trading in some markets, the ease of information flow, and crucially, some deep-seated behavioral issues. We've seen studies, for example, noting low participation rates in the GandM market specifically because of behavioral issues, which just suggests that financial systems aren't purely mathematical. They're inherently social structures.
Okay, so let's drill down into the U.S. participation data and focus on that fundamental distinction that really defines the modern investor: direct versus indirect investment.
This distinction is paramount for understanding modern wealth distribution. So direct investment is when an individual owns the stock outright, maybe in a personal brokerage account.
Right.
And indirect investment is owning shares through third-party vehicles, primarily mutual funds, ETFs, or most powerfully, those employer-sponsored retirement accounts like 401ks.
And the data shows a tectonic shift in how Americans invest, just in that period between 1992 and 2007.
An undeniable shift. Direct participation stayed almost completely flat. They moved from 17.8% to 17.9% of households.
Yep.
Barely a change.
Nothing.
But indirect participation, mainly through retirement accounts, it surged. It went from 39.3% to 52.6%. And the median value of those holdings more than doubled in that same period.
That's a massive transfer of capital flow. It's steering individual investors away from picking their own stocks and towards institutional management. Why did that happen? It sounds like government policy played a direct role.
Oh, absolutely. The differential growth is a direct consequence of the U.S. tax code structure, which powerfully incentivizes indirect investment.
Explain that incentive mechanism for our listener. How does it work?
Okay, so when you invest directly, you use money that has already been taxed, your post-tax dollars. Then, any capital gains you make when you sell the stock or any dividends you receive, they get taxed again in the current year.
A double hit.
Right. By contrast, when you contribute to a traditional 401k, you're investing pre-tax dollars. The growth is sheltered from taxation entirely until you withdraw the funds in retirement, often at a lower tax rate. The entire system is structurally designed to channel the savings of the middle and upper middle class into these managed indirect vehicles.
So the government essentially created a massive, decades-long subsidy for institutions to manage middle-class retirement savings and at the same time reduce the incentive for individual direct participation?
That's the mechanism. And this leads us, unfortunately, directly to the uncomfortable reality of ownership concentration, the nugget of inequality that defines the scale of this wealth gap.
Let's hear the staggering figures for 2025 wealth stratification.
The concentration it's historic. The data shows that the wealthiest 1% of Americans owned nearly 50% of the entire stock market.
Half. 1% of the people own half the market.
And if you broaden the scope to the top 10% of households, they own an overwhelming 87.2% of all publicly held equity.
Pause on that. 87.2%. The wealthiest 1/10 of the population owns almost 9 times the amount of public equity as the other 9/10 combined.
Now compare that to the other end of the spectrum. The bottom half of the income distribution, that's 50% of American households, they owned a minuscule 1.1% of the total stock market.
Wow, 1.1%. That visualization, the extreme disparity, is critical. And if we look at participation rates from 2007, the difference in who even gets their foot in the door is enormous.
The participation rates mirror that wealth concentration. The top decile of income earners had an indirect participation rate of 89.6%.
Almost everyone.
Pretty much. But the bottom quintile, only 10.7%. Even more starkly, almost half of the top decile owned stock directly, compared to a tiny 5.5% of the bottom quintile. The stock market is fundamentally an asset class for the wealthy and the upper middle class.
And the median holdings must reflect this massive difference.
They do. In 2007, the median value of indirectly held stock for that top decile was over $200,000. For the bottom quintile, it was just over $6,000. It's not just a participation gap, it's a capital gap.
And this disparity means that major financial shocks are going to impact these groups very differently. We saw this after the Great Recession.
Exactly. Between 2007 and 2013, households in the bottom half of the income distribution, they were likely struggling with job loss or stagnant wages, and they decreased their participation rate. It dropped from 53.2% to 48.8%.
They had to pull back. They couldn't afford the risk, or maybe they lost their jobs and lost access to those 401ks.
That's the likely mechanism. Conversely, households in the top decile, who have the liquidity and the ability to tolerate losses, they actually increased their participation slightly.
Right.
It went from 91.7% to 92.1%.
So the system reinforced the existing stratification. The wealthy could consolidate ownership during a downturn while the poor were forced to retreat.
And we also have data that highlights deep racial and social disparities in ownership, which are tied right into this concentration.
Let's hear it.
Yeah. So 2011 data shows significant racial disparities. White households were 4 to 6 times more likely to directly own stocks than black households at 6.4% and Hispanic households at 4.3%.
And the national rate was almost 20%.
Right, 19.6%. And though it's less pronounced, the pattern for indirect participation is similar.
So given the potentially high returns, that historical 10% average we'll talk about later, why is the barrier to entry so massive that over half of American households aren't participating, even indirectly?
Researchers have identified 2 key mechanisms. The first one is fixed costs. And this is a really profound insight. One study concluded that a fixed cost of just $200 per year is sufficient to explain why nearly half of all U.S. households do not participate.
$200? That sounds almost trivial in the context of global finance. What exactly is this $200 annual fixed cost that acts as such a powerful deterrent?
It's not just commissions or maintenance fees, because those have largely disappeared in modern brokerage accounts. It's the hidden costs. This $200 covers the cognitive load, the time and effort you need to learn the system, open an account, file the necessary tax paperwork, and crucially, the cost of information.
So the time.
The time. If you feel you need to spend 10 hours researching before you invest your first $500, that time is an economic cost. For low-income households, the annual expected return might not feel worth that initial effort, and the risk of misunderstanding a really complex system.
So it's an informational and psychological barrier that's masquerading as a financial one. If you're living paycheck to paycheck, allocating $200 or the time needed to acquire the knowledge is a massive opportunity cost that outweighs the abstract promise of long-term returns.
Precisely. And the second factor is sociability, or social capital. This suggests that investment knowledge and comfort it diffuses through communities. If you live in a community, a neighborhood, an office, a family where people regularly discuss their 401ks or mutual funds or how to set up a brokerage account, the transaction cost of knowledge is dramatically lowered. You learn by osmosis.
And if you don't have that exposure, if none of your neighbors or colleagues participate, that informational fixed cost of $200 becomes infinite because you have to learn everything from scratch, relying on unfamiliar, complex financial media.
That's the feedback loop. This explains why the racial and income disparities are so stubborn. If marginalized communities lack the historical context, the wealth foundation, and the social network for knowledge diffusion, they are perpetually subject to that prohibitive fixed cost. And that perpetuates the 1.1% ownership figure for the bottom half of the nation. It transforms investment access from a purely financial problem into a social and cultural one.
We've established the geography of capital and the stratification of ownership. Now we shift our focus to the dynamics, how prices actually move, and why sometimes they move without any apparent reason at all. For decades, the intellectual foundation for this was the efficient market hypothesis, the EMH.
Right, the EMH. In its strictest form, it states that asset prices reflect all available information. So if a stock is trading at $50, that price is the perfect, rational amalgamation of every known fact, financial report, and public opinion about the company.
Which means you can't consistently beat the market because all the information is instantly priced in.
That's the theory.
If that were strictly true, we should never see these dramatic, chaotic, unexplained price shifts. But we have. And that brings us to the great contradiction that really shattered the hard EMH, the 1987 Black Monday crash.
Black Monday, October 19th, 1987. The Dow Jones Industrial Average plummeted 22.6% in a single trading day.
22.6%.
It remains the largest one-day percentage decline in U.S. history. The market lost almost a quarter of its value in a few hours.
What makes this crash the ultimate failure of the hard EMH?
A thorough post-mortem investigation failed to detect any generally agreed-upon definite cause. There was no proportional, reasonable development in fundamental economic information that could account for that massive collapse.
No sudden war, no catastrophic earnings report.
No major economic policy change that day, nothing. The price collapsed dramatically, driven by panic selling and exacerbated by new computer-driven trading programs, but fundamentally it was a psychological crisis, not an economic one.
The market reacted, but there was nothing external to react to. It was a mass internal failure of confidence.
This event forced a fundamental shift, leading to the adoption of the soft EMH. This softer version acknowledges that, okay, prices do not always remain at equilibrium and that massive irrational swings are possible, but it still maintains that participants can't systematically exploit these anomalies for profit over the long term.
So we turn to behavioral economics to fill that gap. What specific psychological factors are driving these massive irrational price movements that the EMH just can't explain?
Well, behavioral research outlines several deep-seated human predispositions. First, our brains are hardwired to detect patterns. We look for a signal even when there's only noise.
Right.
In the market, if a stock has a succession of good news days or upward momentum, investors exhibit what's called positive overreaction. They perceive a sustainable trend that may not be fundamentally supported, and that leads to self-fulfilling price surges, a bubble.
This is confirmation bias in real time. We want the narrative to be true, so we overweight the positive signs and underweight the negative fundamentals. And this overreaction creates a crowd.
And that crowd mentality is the second major factor: group thinking. Humans are social animals. We feel cognitive dissonance when we hold an opinion that differs wildly from the majority. Think of how hard it is to be the first person to invest when everyone else is pulling their money out.
The risk isn't just financial, it's social.
Exactly. People prefer to have their opinion validated by the group. So when euphoria or panic starts, this group thinking quickly overrides individual, rational assessment, and it amplifies the move far beyond fundamental value.
That's why financial bubbles are often described as manias. The market ceases to be a machine for calculating value and becomes a collective expression of hope or fear.
And behaviorists capture this distinction beautifully, using a gambling analogy. In normal, rational times, the market is like roulette.
Roulette.
Yeah, the probabilities of an outcome are known, and they are largely independent of what other players are doing. Your neighbor's bet doesn't change where the ball is going to land.
Okay, but when does the game shift?
In times of market stress, when the system is buckling or some major piece of information hits, the game suddenly becomes like poker.
Poker.
In poker, your success depends entirely on reading the psychology of the other investors. You might have a great hand, but if you perceive the market as overwhelmingly panicked and about to fold everything, your best move might be to sell, not hold. The psychology of others becomes the heaviest weight in your decision.
That is a fascinating shift. It means the critical skill changes from economic analysis to mass psychological assessment the moment a crisis hits. And these mass psychological failures, they lead to crashes.
They do. A crash is a sharp, sudden dip in share prices, almost always ending speculative bubbles and driven by that loss of confidence and panic. We have a long history of them. The Wall Street crash of 1929, the 1987 Black Monday, the 2007-2009 Great Recession, where the S&P 500 fell 57%.
And the very compressed 2020 COVID crash.
Exactly. The COVID crash began in late February 2020 and saw this terrifyingly fast descent before a sudden turnaround in early April of that year.
So the lesson of 1987, being this purely psychological event, was that the systems themselves needed a mandatory pause mechanism to defeat the speed of panic. And that led to the implementation of the circuit breaker.
Correct. The core structural response was to upgrade the computer systems and introduce the circuit breaker, these predefined thresholds designed to halt trading temporarily. The goal is to enforce a cooling-off period, allowing genuine information to diffuse and rational assessment to displace the panic selling.
So let's detail the NYSE rules for the listener. How do these circuit breakers actually activate?
The rules are tied specifically to the S&P 500 index movements. A 7% drop in the S&P 500 triggers a level 1 halt. A 13% drop triggers a level 2 halt. Both of these halts will freeze trading for 15 minutes.
And the most severe?
A 20% drop. That triggers a level 3 halt and stops trading for the entire day.
And critically, there's a time cutoff on those first two levels, which I think often gets missed in the headlines. The 3:25 p.m. rule. Why does that timing matter so much?
The 3:25 p.m. cutoff is vital. It prevents the panic from spiraling into the closing bell. If a 7% or 13% drop occurs late in the day, after 3:25 p.m. Eastern Time, the circuit breaker does not halt trading.
It just lets it run out.
It's allowed to close, but the next morning the circuit breaker rules immediately apply. This rule exists because closing the market entirely right before the end of the day can create tremendous operational and settlement issues, and that could potentially exacerbate panic overnight. By letting it close, it ensures that if the market is going to open severely down the next day, it does so in a controlled environment, not during the chaotic last few minutes of trading.
That's a fascinating insight into the regulatory mind. It's an admission that sometimes the collective psychological momentum of the market is just too powerful for rationality to overcome, and the only solution is a forced timeout.
And if market psychology drives the size of the moves, leverage is the amplifier. Leverage is simply a financial strategy that allows traders to control much larger blocks of stock than their immediate capital would normally allow.
It exponentially increases both potential profit during a surge and, critically, potential loss during a panic. We should detail the two main leverage strategies that magnify market chaos: short selling and margin buying.
Let's start with short selling. It's often villainized, but it's a necessary component for price discovery. A trader believes a stock is overvalued. They borrow shares, usually from their brokerage, and sell them immediately on the market. They get cash from that sale.
And their bet is that the stock price will fall.
Right. If the price falls, say from $100 down to $80, they buy the stock back at $80. That's called covering. Return the shares to the lender, and they pocket the $20 difference minus fees.
It's the ultimate contrarian move, but it carries the risk of unlimited loss.
Exactly. If you buy a stock, the most you can lose is 100% of your investment. If you short a stock, there is no theoretical limit to how high the price can rise.
And we have to clarify a critical regulatory point: naked shorting. Why is that illegal in most major markets?
Naked shorting is the practice of selling shares that the seller has not yet confirmed they have borrowed or can even borrow. The danger here is that it can flood the market with phantom shares, potentially manipulating the supply-demand curve and driving prices down artificially. It creates a major systemic risk because there's a failure to deliver the shares. It's essentially trying to sell something that doesn't exist yet, which leads to settlement chaos.
Okay, so the other major form of leverage is margin buying, which is how speculators traditionally increase their purchasing power.
Margin buying involves borrowing money at interest directly from a brokerage firm to purchase stock. This practice was deeply implicated in the unsustainable speculation that preceded the 1929 crash.
The requirements were much lower then.
Shockingly low. Speculators only needed to put up as little as 10% of the total investment. Imagine the volatility when a stock dropping 10% wipes out 100% of the investor's cash.
So the subsequent regulation clearly targeted this excessive leverage. What is the current standard?
Following the disaster of 1929, the Federal Reserve stepped in to regulate this under what's known as Regulation T. For many years now, the standard margin requirement in the United States has been 50%. This means for every $1,000 investment, you have to contribute at least $500 of your own capital.
Which dramatically reduces the volatility.
It does. But if the market moves against a margin buyer, the brokerage firm has loan capital and needs protection. That brings us to the most feared mechanism in leveraged trading: the margin call.
A margin call.
It's the safety valve for the brokerage. It's issued when the total value of the investor's margin account falls below a certain maintenance requirement, meaning the collateral can no longer safely cover the loan. The investor is then immediately required to add additional funds, cash, or securities to bring that equity percentage back up.
And if the investor can't meet that call, what happens?
If they fail to provide the funds quickly, the brokerage firm is legally and contractually obligated to liquidate, to sell off the margin securities or any other assets in the account to protect its loan position. Modern trading systems ensure these calls are automated and rapid.
That acceleration is what makes margin calls so dangerous during a generalized downturn. A crash doesn't just trigger individual losses, it triggers mandatory automated selling across thousands of accounts.
It's a massive fuel injection into the selling spiral.
Yeah, it creates a forced contagion. The brokerage firm is protecting itself, but in doing so, it forces price discovery lower, which triggers more margin calls elsewhere. That mechanism is just a powerful amplifier of market stress and volatility.
It is.
So we covered a tremendous amount of ground today, navigating the sheer scale of the stock market, the technical plumbing of the exchanges, the profound inequality in ownership, and the psychology that overrides rationality during stress.
Let's quickly summarize the critical takeaways for you. We started with the immense scale, that global market cap hitting US $111 trillion by 2023.
A huge number.
Then we showed the immense concentration of ownership. The wealthiest 1% of Americans own nearly 50% of that market, while the entire bottom half owns just 1.1%.
So stark.
And finally, the market is demonstrably not the rational machine of economic theory. We see that with Black Monday and the need for circuit breakers, which is a direct admission that panic requires a timeout.
It's easy to focus on the crashes and the risk, but the reason people participate, even indirectly, is the promise of long-term returns. What is the benchmark average?
Well, our sources indicate that the historical average annual growth rate of the S&P 500 index, a key benchmark for U.S. equities, has been remarkably consistent, around 10%.
10% average return over decades. That's the engine that drives those retirement accounts.
But that leads us directly to our final provocative thought for you to explore. While 10% is the nominal return, we had to factor in the impact of inflation, which typically averages, 2% to 3% annually. This inflation constantly erodes the real purchasing power of your money.
Right.
So in a market that's dominated by these indirect tax-advantage retirement accounts, where the money is locked away for decades, the critical question is, how much of that long-term 10% gain is truly felt by the average retail investor after you account for inflation, the often hidden fees of their managed funds, and the taxes upon withdrawal?
The headline number is 10%, but what truly determines your long-term wealth isn't that nominal return. It is the real rate of return, the actual increase in your buying power over time. And that is the essential concept we encourage you to look up next and factor into your own financial thinking. Thank you for joining us for the deep dive.